Hi everyone, and welcome to Meet Your Trading Experts live and free. My name is Paul Botterill. I am your host. It is great to have your company today. If you are on Facebook, if you are on YouTube, if you need to ask any questions, just put them in the questions box. If you're in the Zoom session, if you have any questions, put them in the questions box. And this show is a little bit different. Look, I like to do my interviews live with you guys, but Gordon Scott lives in just out of Salt Lake City in Utah, and the timing just doesn't make that possible at all. It's about 5 o'clock in the morning. US right now. So I recorded this yesterday morning with him, and look, what a just amazing amount of knowledge this man has. Look, settle in, spend 30, 40 minutes listening to this interview. Look, the first thing I did was ask him about being Gordon Scott CMT and what a CMT was. And I think his answer took maybe 10, 12, 13 minutes when he talked about the CMT, his role in the CMT, what works, what doesn't work, their research, amazing stuff. So I really encourage you guys to sit back, enjoy, make some notes. I think it's one of the best educational interviews we've ever done. We will be doing a little giveaway at the end of it as well, and as well as that, there'll be some chances to join Gordon on a couple of programs he's got coming up. So hang tight. Maya, are you okay to play the video? Here we go, guys. Gordon Scott, CMT. Hi, everyone, and welcome to Meet Your Trading Experts live and free. My name is Paul Botterill. It's great to have your company today. My guest on the show today is Gordon Scott, CMT. Great to have you along, Gordon, and it's about time we got you back on the show for a decent period of time, one of our most popular guests. Gordon, I wanted to start off today by saying, you know, Gordon Scott, CMT, it's a bit of a mouthful. What does CMT mean? What actually is a CMT?
Thanks for having me on, Paul. It's good to do this every time. My CMT designation stands for Chartered Market Technician, and that's a designation like Chartered Financial Advisor. It's FINRA recognized. It's like the CFA or Kaya or one of these others that has a specialty. Its specialty is technical analysis, literally chart reading, and there are 3 different exams. I was super excited when I got the designation by passing all 3 levels of exams. But I got to tell you, as much as I learned, and I learned a lot by going through that, I learned even more when it just so happened that I was able to become the managing director of the CMT program, which meant I was in charge of the curriculum for 4 years. I was in charge of coming up with the test questions and which books were going to be included in the readings. And then eventually I worked with Wiley to come up with our association's own book, which was actually pieces of a bunch of different books. And then we had some of the people in our society who were actual professional technical analysts, and they would write up original chapters. So, you know, now the curriculum's in a really nice spot. It's a lot of focus on risk management, but that exercise of having to go through everything, because as I'm sure you know, Paul, there's a lot of hocus pocus in chart reading, and it's you know, how do you elevate the practice beyond the sort of tea leaves kind of thing? And there's a lot of guys educated at, you know, top business schools around the world, and they get told by their professors, oh, that stuff is nonsense. It's just and there's one reason why the professors are right to say that, because the markets have sufficient degree of randomness that choosing anything as an indicator has a limited value in terms of predictability. But it's extremely duplicitous of them to say, oh, well, technical analysis can't be used for prediction, but let's look at earnings and economic data. I mean, you know, if you think it's hard to figure out what a chart pattern is going to, you know, predict for the future, I can promise you that there is even less predictability in being able to correctly interpret and tease out the details from earnings or economic data to be able to know which way price action is going to go next, just off of that.
And look, it's the same thing, isn't it, right? Sorry, couldn't
I? Yeah, it really is. If the markets are random, they're random. It doesn't matter which one you're gonna go with. So what I had to do was to look through the curriculum, look through all the possible inputs to the curriculum, and understand which authors took a sort of, you know, modern view of technical analysis, which is not, oh, here's a Head and Shoulders, it's definitely going down from here because the Head and Shoulders says so. It's like, all right. People have done some backtesting studies, and some people put out the fact that there's a 56% chance, and some say a 62% chance of a Head and Shoulder reversal. But truth is, you got a Head and Shoulder in the middle of a strong uptrend. That Head and Shoulders can just get run over by the trend, and you don't want to bet the farm against it. So I had to look for stuff that people were. There's a great book by David Aronson called Evidence-Based Technical Analysis, and we drew heavily from that book and several chapters in it, and another book by Perry. I just lost his last name. New Methods in Trading Systems, and his book is fantastic, but it's really dense. It's 1,200 pages, and he's writing every little detail he thinks about, and so you got to comb through and sort out the stuff that's actually usable. There's a nice book by John Murphy that talks about all the various technical elements. And it's very good, very easy to understand. But then when you press into it, there's no direction on this is better than that, that is better than this. And the whole thing was just, well, it's a body of evidence. The more evidence you get, the more technical analysis is going to tell you. It's like, okay, wait a second. If the markets are random, will it really make a difference if I use one indicator or two or 5 or 20 or 500? I started talking to guys who actually managed money based on technical analysis, professional money managers. Probably the individual who managed the largest fund, $13 billion, specifically dedicated to technical analysis. A guy by the name of Dave Lundgren. He worked for Wellington Asset Managers, and he came and it was part of our association. It was really great because I got a chance to work with him. I asked him about that. What is it that you do, and how do you manage? And I was expecting all sorts of technical and quantitative and fundamental all woven together in some sort of proprietary. I can't tell you, I'd have to kill you. I was expecting that kind of stuff from him. But what I got back was, well, really, it's quite simple. We rely a lot on trends and relative strength. And we'll look at everything. We pay $50,000 a month for a wide variety of research, but what it comes down to is just relative strength and trends. And so he and I got to compare notes, and it was really interesting. I actually heard that a lot from the professionals, that sector rotations, sector analysis in stocks, or economic rotations in currencies. And when crypto came along, it was a sort of function of how much time, what's the average hold time for a crypto account. You go on a brokerage exchange, and sometimes they'll have that data. They'll just tell you, here's the average hold time for users right now. And then you go back and you look at that average hold time, and you can see there are patterns based on that timing. And so the idea is not that a particular chart pattern, Nassim Taleb wrote a book, Fooled by Randomness. And in it, he used a famous study that was people were given to look at charts, and then they were given random charts, and they thought the randomness had patterns in it. They were as sure as stuff that was made up and random data as they were looking at market charts. And he used that to prove, see, you're fooling yourself. You don't really have anything. He kind of misses the point. A lot of people use and refer to that book just to say, well, see, markets are random, totally unpredictable. Oh, okay, then why are you investing? Right? Because if they're totally unpredictable, you shouldn't even be bothering to put your money in. And if you look at stocks, they are lower left to upper right for 100 years. You look at Forex, and it's a little bit different story, but there are long-running trends between the various pairs. There's always something going somewhere for at least some period of time, right? You look at crypto, and it depends on how you look at it, right? The time frame and framing of the data and the time and the storyline. But big picture, Bitcoin was low and Bitcoin's very high by comparison, even despite the recent selling, So
yesterday, yep.
Yeah. So it's just really a function of those trends do exist. And if they were straight random, you would just see noise. You would just see, an EKG, echocardiogram, kind of up and down, sideways, nothing type of market. There would be no opportunity. Why is it then the markets exhibit opportunity? Well, I did my own study to answer that question for myself for a couple of years before I became the director of the CMT Association's curriculum and testing activities. And I found something really amazing, Paul, and you've heard me talk about this before, but that randomness actually generates its own trends. As long as you have something that nudges it, then you can predict which way that trend is going to go. In the case of U.S. stocks, you've always got the Federal Reserve adding a little bit of money and creating a controlled amount of inflation. And so that just sort of tilts the scale and up you go. And the question of, hey, where should I buy? If that's an upward trend, I should be buying the dips. Where are the dips? That is all a function of time frame and objective and so forth. So technical analysis has its biggest value in helping you establish your risk and reward. Saying, okay, I got a head and shoulders pattern or a flag pattern or whatever. Which flag patterns, by the way, are actually the best pattern format that regularly appears. There are a lot of candle patterns that are pretty good, but the single best price pattern has proven over time to be a flag pattern. But in any event, let's say you're looking at a flag pattern. It's run up, it's coming back down, and you're getting ready for it to break out and continue. So a lot of people want to say, well, there's the flag and it just broke. That means for sure it's going up, right? No. Don't do that to yourself. What you do is say, this could be a trend exhibited from this point.
Yes.
What I need is a place where if the price data comes down to that level, it will not be a continuation, or it's not following the pattern that is seen in continuations. And then I'm going to cut my losses. But if in fact it goes from here, it will keep going and I will move my stops and therefore get a bigger payout than I would loss. So in terms of managing your risk to reward, technical analysis is fabulously effective and useful. I was just shocked when I would go to our annual symposium and we would have some very prominent money managers come and be part of it because, they kind of didn't like to advertise the fact, but they cared about technical analysis too. But they were mostly, fundamental shops and all about the earnings and so forth. And so they'd come, they'd just listen to what we had to say. And occasionally I'd corner them and ask them, okay, so, what's your process? And what just blew me away, Paul, is that none of them use stops. I mean, one guy, he was managing 4 billion and he said, I can't use stops. I got 1.7 million shares of Microsoft. I'm going to tank the market if I try to get out of that at any particular time. So I need something in technical analysis that gives me the ability to manage my position without having to exit my position. And so that's, what he was coming for. But most of the guys, even if they were managing 50 to 200 million, they didn't have his rationale. They didn't understand why. They just said, no, I don't use stops. Well, then how do you know how much you're risking, right? Well, the more disciplined of them would say, well, I on any given fund, I'll distribute the money into 50 different positions and I'll risk no more than 2% per position as I start out. That changes and I can occasionally have to rebalance. But in that way, I'm risking no more than 2% on any given investment. And so that kind of makes sense. But what they don't understand is what they're really doing is setting their stop loss at 0. So
Yes.
they put in a 2%, and then they're going to risk all the way down to nothing. And I would rarely, occasionally just for fun, I would press them and say, so do you think that stock has any chance of going bankrupt? No, it would never go bankrupt. Okay, so if it dropped 50%, would you buy more? It's not going to drop 50%. Okay, so then if it's not going to drop 50%, why don't you go ahead and put a stop loss on 50? He said, no, we just don't play the game that way. Yeah, well, you don't think your game through, period, because what you just told me is you are wasting the use of 50% of your capital applied to each position.
Gordon,
Because it's not going down there, and yet you're tying up that money and letting it sit there. It's very lazy investing.
I want to, there's been a heck of a lot in there. I want to go back to some of the stuff right at the start, if you don't mind, Gordon. So one of the things you talked about at the start was that, some people say that technical analysis doesn't work, and some people say, and you said that, you want to try and look at balance sheets and try and work out from there what stocks are going to do, because that's just as tough. But really what this is about is being good at something. It's not about being good at everything, right? It's about saying there are people who use technical analysis who make a lot of money because they're good at technical analysis. If you're bad at technical analysis, it still won't work. Is that a fair statement? You've got to become good at it, right?
Yeah, well, I think the thing, yes. However, the thing about technical analysis that you have to become good at isn't, predicting. Elliott wave pattern or Elliott wave theory is a great example. I mean, I love the guys who are big into Elliott and the people at the Elliott Wave organization, Elliott Wave International. They're great guys, but they get really wound up in the idea that if I just work hard enough at my Elliott Wave model, then it will be predictive. Well, then they will have to spend maybe 20 minutes per chart, maybe hours. Some of them I know. There was one guy who worked for Citibank, and he was in the Forex desk. And he would literally spend hours, and he was very good at coming up with a prediction using Elliott Wave for Forex markets. But I mean, Citibank paid him a nice $250,000 a year salary, and so he had honed his craft. Good for him. When I go to my Oanda account and I start trading, I'm not going to spend all day trying to come up with an Elliott Wave model. If I look at an Elliott Wave chart, which is not a bad thing to do, all I have to do is look at the last part of the chart. Where's Elliott Waves? Where's the Fibonacci line? How far away am I from it? If I want to take the trade, all I have to say is the Elliott Wave model will break if it goes below that Fibonacci line. So I'm going to enter the trade here and exit the trade there. Meanwhile, if it goes back to the next Elliott Wave level, because you get to 4, you come to 5. In order for the next one to actually be a wave, it's got to go above 5, right? So I can say, according to this Elliott Wave analysis, I should have only 20 pips of room, and the price action, if this analysis is correct, could create 100 pip return from that. Fantastic. I want to take that trade every day. I want to take that if I think it's a 50-50 trade, but it has a 1-to-5 payout, right? So what you got to get good at is recognizing, how do I apply my risk management and risk to reward to the technical analysis or the fundamental analysis or whatever you use. Every single one of the guys I talk to, technical shop, fundamental shop, quant shop, all of them, I would say, which of these 5 topics do you think is most important to focus on? When you're in the biz and you're working for a company and they want you to get results, which one of these makes the most impact on your job? And, technical analysis, fundamentals, I'd have 5 topics. One of the topics was risk management. And without exception, every one of them called risk management either number 1 or number 2. So I restructured the curriculum around the notion of how do you use technical analysis to fit risk management. And, I've been doing that for years, since that was a lot of fun because I had all sorts of ideas on how to do it. Since leaving the CMT and working formerly at Investopedia and now with a number of independent clients, I do that all the time. I help people recognize, here is the simple way, because you don't have all day. If you're an individual trader, you don't have all day to go through the 10 Qs of stocks or the economic data on Forex Factory. And I mean, yeah, have at it. Enjoy the reading if you like. But would you like to know how to quickly look at a chart in less than 5 minutes, understand your risk reward, understand how it fits your profile, understand whether or not it's your trade to take? That's what I try to focus on.
So look, I want to see if I can sum this up. And I knew when I spoke to a chartered market technician, I was going to hear some really interesting technical stuff. And look, I love the perspectives. What you're saying really for mine is that 95% of technicians try and use technicals for target and entry, but really the best use of technicals is to define your risk. Because when you define your risk, everything else fits into place, right? You can work out, and you're going to do banking on randomness for us on Sunday. You're going to go and we know on the IFP, we talk about hunting dogs, jaguars and falcons. You're going to expand that out to a full personality, run through the detail on a lot more levels of that kind of stuff. And this is where you go, well, that's my risk. This is my personality. Does it fit within my brief? And if it does, I'm trading. And if it doesn't, I don't. Now, this isn't I'm 2 weeks into my trading career stuff. This is when you're 2 weeks into your trading career, get a strategy, trade the strategy, and learn about charts and learn about stuff. And as you develop, add this stuff in, right?
Yeah. I mean, just a real good example is last Friday, I was looking at the Aussie yen pair, my favorite Forex pair to be looking at.
Yep.
And I was looking at the NASDAQ, and right before the close of the market, about an hour before the close of the market on Friday, I looked at it and I realized there is a high probability based on that candle and that behavior that the markets are going to go down on Friday, if not just straight up gap down. Now, I didn't know that Evergrande was going to have all this drama about possible defaulting and Hong Kong real estate cracked down by the Chinese government. And, I didn't know any of that. All I looked at was, this looks like something I've seen before and something that could create an opportunity. It's an opportunity I want to play because I feel like it's either going to happen or it's not. That's 50-50. If it doesn't happen, I'll know immediately how to get rid of it. But if it does happen, best case scenario, it's going to gap down and then keep going for me. Well, I got the best case scenario. And did I know that was going to happen? Not at all. But I did know how much risk I was going to take. And, those trades that I put on, they paid off 4-1, Paul. And it just happened to be a really good trade this time. But I didn't care how it came out. I knew that if I make that trade consistently 10 times, that I have a positive expectation, or an expectation of having positive returns.
I really like that. And I think one of the things that, if you're listening to this and you're looking for some takeaways, one of the points here and don't let this go past you, right, is if you can define and control your risk, you can stay in the game. Guys that do that properly are in the game for a long period of time. Guys that don't control their risk are gone, and they're gone in months. So the ability to define and understand your risk gives you the longevity to learn to become a bloody good trader apart from anything else, right? It's a really
that is
cornerstone of the whole thing.
It is. That is such a dramatic data comparison. It's very objective, very hard fact-based, that the longer you stay in, the better your chances are. If you look at a study that was done for 10,000 Taiwanese day traders, these are intraday traders, right? And they're trading either the Taiwanese stock market or Forex or whatever. And they're people that took more than $1,000 into an account. I mean, some much more, some just. And what this study did was they managed to get data from the broker where these accounts were. So the data was bona fide. It wasn't people, self-reporting or anything. And they looked at over 10,000 accounts of traders, and they reported that the majority of those traders would wash out. That is to say, stop trading. They defined this by that they lost something like 80% of their account and then they didn't replenish it, and so they called that a failed trade. And something like 94% of traders fell into that category within 4 months. The biggest bulk of them was only 2 months. And so, a lot of people use that study to say, look, trading is a terrible idea. You can't make any money at it. It's worse. It's the worst startup business you could ever have, blah, 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 right? But they failed to notice that in that same report, it said of those who managed to stay, trading, to continue to keep trading for over a year, the success rate went from 4% to 40%. And those that managed to keep going a second year, the rate was 60%. 60% of those were successful traders if they managed to just stay alive for 2 years. And but the idea that you go from 4% to 40 just in a single year, that is a 10x increase in the probability of success. Now, if somebody came to you and said, I have a way that you could start a small business, and you can start it with as little as $1,000 or $5 or $10 or whatever you have, right? And I'll give you a 40% chance of success. If you put a year into it, you'll have a 40% chance of success. I don't think you can find many startup businesses you can do at home, business you can do in your spare time, business you can do over your phone, at public transportation or at your kid's football game, right? I mean, it's like you cannot find a small business that would give you a 40% chance of success. But if you do trading right, if you manage your risk, that's precisely what you have.
That's amazing, isn't it? I mean, I think those of us that have had small businesses, I think we all know that, the success rate for small business startups is actually a lot closer to the 4% that they just don't get through. The majority of small businesses just crash, you add COVID to that, and it's just, I'd imagine the rate at the moment of them going under is extreme. So 4% for the first year. So the first thing my job as a trading educator to do is to get guys through the first year. If I can do that, they're on their way. And at year 2, look, and this is one of the things, if you're looking for people to help you on this journey, if they haven't been active in the market for 2 years, they are not the people who can help you, right? That tells me, right? Interesting stuff, Gordon.
That's true too.
One of the things it tells us is that it's not that, in the first year you got a 4% chance of, succeeding. But succeeding is not one-to-one. Succeeding isn't you put in $1,000 and you make $1,000 a year. Succeeding is very well leveraged over time if you can succeed at it, right? So look, it's fascinating stuff. I want to touch briefly on a couple of things, Gordon. One thing that's coming through, first of all, I've got one question for you. Aussie yen, it's your risk monitor, isn't it? It's the safe haven yen versus the commodity-based Aussie, but a bit of a link into China. It's a bit of a barometer on markets, isn't it?
Yeah, global investors, big banks, like to use the Aussie yen because it's the first one on the calendar, the first one on the clock to start open up and trading. It's got the nice interest rate differential. And so if you got $1 billion, you want to park it early in the, global day, you're going to go to the Aussie dollar or the US dollar, Japanese yen, or the Aussie yen, depending on, what your particular slant is for commodity exposure and risk exposure or interest rate exposure, all of that. But it's going to be one of those 3 pairs. The Aussie yen, unlike the other 2, remains 75% correlated with the NASDAQ 100. So it's this fascinating bridge between the Forex and the US stock markets. If you're looking at the NASDAQ and you're looking at the Aussie yen, you'll see that they trade off, pulling each other one way or the other. And you can really get some valuable ideas on where the trades are going to go. Just again, back to this past weekend, the Aussie yen broke a whole hour early around midnight Eastern time in the US. It had already started a very significant break lower, and then the NASDAQ followed. And if you were on that, you would you'd be able to come to the NASDAQ either as the futures or some other CFD or something. You'd be able to put that trade on because the Aussie yen told you an hour ahead of time to do it. But what if you miss that trade? What if you don't get up or look at the markets until later, right? Well, if you saw an hour before the U.S. market opened what the Aussie yen was doing, it was hitting and breaking lower on each support. It would go down, hit support, kind of rest, but then it would drop lower and lower and lower. And the NASDAQ went down and kind of bounced up and sort of held a little bit. But within a half an hour after the market opened, the NASDAQ was pushing lower. And so at that moment, it was an easy trade on the Aussie yen, right? Because if the NASDAQ's going to push lower, the Aussie yen has to go lower, especially if they're in that tight correlation mode right now. I mean, on any given day. And they were in such tight correlation mode that as soon as the NASDAQ rolled over, within a half an hour after it's open, if you're not trading U.S. stocks, you've got a fabulous trade on the Aussie yen going south. And so I mean, there's just all kinds of cross correlation that you can get between the two, and it's very simple. It's just, what is that doing? What is that doing? None of this, econometrics and stuff required.
Amazing stuff, right? So one of the things that I guess in experience, Gordon, how long have you been trading? What's your experience? What's your time in the market?
I've been doing this for 20 years, and I got started when I was 38 years old, and I had just finished working for IBM for 10 years, and then I had gone to work with a startup company. I was about 70 people. We were a spin-off of a larger group. And I was hired as the business development vice president, and I was going to be next in line to become CEO. The guy who was the CEO wanted to retire in 5 years. And so, life was glorious, right? Well, the one little hitch we had was that all of our customers were either software companies or internet companies. And the year was 2001. So
Yeah.
you know how that dot bomb story ends.
Yeah.
And so one day I found myself at the public library, commiserating and over my lot and the fact that my career was dead, and my career wasn't trading, it wasn't financial at all. I was in the business of multimedia instructional development, as it turned out. And so I just thought, what am I going to do? And there's an old movie, Billy Crystal and Ed Norton, a few other guys, City Slickers. I don't know if you've ever heard of it or seen it. But in there, there's this fun little story about a guy who's messed up his life. And in trying to cheer him up, his buddies say, hey, look, just think of your life as a do-over. And somehow, as I'm sitting there, stewing in my own self-doubt, that scene came to mind, and I thought to myself, all right, my career is a do-over. What do I want to do? What could I feel fired up about? So fired up, even I would do it even if nobody paid me to do it. And right then, what came to mind was stocks and the stock market. I just have to learn something about the stock market. Now, I had been trading my own 401k as I worked for IBM. I didn't really know a lot about what I was doing, but I was trading it because the only thing they had all these mutual funds, and then they had this one fund, which was IBM stock. And so I would literally go in and out of IBM stock. And over the course of 10 years, I doubled my money. That's independent of my contributions. My growth rate was to double that account. And, I didn't even get sizable until I was in 5 years. So I look at it at about a 5-year period of time. I doubled my contributions. And so I thought, hey, I know what I'm doing. Well, okay, it was the late 90s. You do anything and it goes up, right? Yeah. But I had been fascinated by how could I learn to do this with a wider array of instruments? And that's what got me started. I went and checked out every book I could in the library. And I just started being a sponge, talking to everybody. Weirdly, I came across this guy who lived about 2 miles from my house. I never did meet him personally. It was just over the phone and email. And exactly how I met him, I really can't remember. But I found out, that he lived nearby, and that when he found out I lived in his hometown, he was okay to let me call him and just talk with him, although he never told me his last name. He didn't want me to come bug him at his house. He was a retired NASDAQ market maker, and he day traded. He and his wife, they didn't have any kids. They just had birds. They just day traded in their house during the day, 5 or 6 hour session. And then they go out and do whatever they wanted to with the rest of their day. And trading was fun for them. That's how they made their living. They just traded their nest egg, and and they did well at it. So I asked him, what is it I need to learn? And so once a week we would get on the phone and he would teach me what he thought I needed to know, about technical analysis, about fundamentals, about intermarket connections between stocks, commodities, forex, futures, anything that he felt like I would let him teach me, he would tell me about it. And that began my journey. And ever since then, I sought out the best possible experts I could find. I was so blessed to be able to be in that position in the CMT Association. I'd learned a lot. I was the head of Invest Tools for 4 years curriculum, and I was the head of curriculum and training for an outfit called Beacon Learning Group. And so I've had a lot of positions where I've just been able to do all kinds of research. But being in the CMT and having to read literally 1,000 writings on technical analysis and work with a team of 20 other experts to write test questions and answers was just an invaluable moment. And I was able to distill what does it really, what's the most important stuff I got to look at when I look at a chart. One more quick story on that.
Can I jump in before the story? Just one thing before the story, if you don't mind. So we're extremely lucky, right? Because you've got 20 years experience, you've worked for CMT, you've helped write the curriculum, you've researched it, and our people can access that. We've got banking on randomness on Sunday, which people can still enroll for. I think it's $150 for 1 day with you, or $350 for 4 days with you, and they can get all that knowledge. And it's ridiculous. And I really do appreciate the offer you've made to our people, because it is ridiculous. And what I will do is I will get even as we're going through this recording, to put the link to that into the chat. So anyone that does want to join, look, if you're listening to this and you're thinking this would make a difference to me, look, if you're listening to this and thinking this would make a difference to you, then you must be one hell of a trader. Because I listen to this kind of stuff and I think, wow, there's some stuff in here for me. And I think if there's some stuff in here for me, there's probably some stuff in here for you. So if you want to join, I think it's $147 for Sunday. I think it's 10 till 4 on Sunday. And we've got 3 other courses in November that tie into that for $347, I think, for the whole lot. I'll check that before we put the recording out. But if you want to take the learnings from all this kind of stuff, what Gordon did was he found the best experts he possibly could to learn from, and he became the best expert you can possibly learn from yourself. Just really quickly before we come back to Gordon, my experience of learning to trade was sitting in Denmark with Leon Ho in the freezing cold snow, having a coffee, and that man was making a fortune trading the US stock market. Sorry, the Australian stock market. He was up all night. And the one thing he wouldn't talk to me about was the Australian stock market. What he'd do is he would talk to me about markets and how they worked and what I needed to know, what books I needed to read. And eventually he just said to me, you've got to, you're a guy who's got an inquisitive mind. You'll be great at this. Just put some money in a trading account and start. And a week later, I turned $2,000 into 52 grand. And I knew what I was going to do for the rest of my life. And, you've got to find the people who can put you on this journey, right? Because Leon Ho, without doubt, gave me the confidence to put some money up. And, just like having someone for you, you've got to find these people. And our people are very, very lucky to have people who want to pay that forward available to them. I did stop you. Sorry, back to you, Gordon.
Oh, no problem. I was going to mention this one story. I actually interviewed 2 guys at Fidelity, the large $1 trillion broker, right? Yeah. Fidelity has 75 portfolio managers, maybe more now, but at least 75 guys who sit around and manage the mutual funds and the various funds that Fidelity runs. And many of them, their best ones, manage multiple funds. Now, Fidelity actually cares about technical analysis. They never do anything solely on technical analysis, but they do have 2 full-time guys that read the charts for everybody else. That's their job. And they were telling me, like, yeah, we have this really thankless job. And I'm like, really? Why? So they expect us to do all their chart reading for them. And I thought, that sounds like getting paid for fun. I don't know why you're grumping about it. He's like, yeah, but every day we have to do a daily briefing, and they actually expect us to review 500 stocks. And I thought, 500 stocks. How can you read 500 stocks and not spend all day reading 500 stocks? Read 500 stocks before everybody's done with their coffee so that they can get on a call at 9 o'clock and you can tell them, here's what we found in these 500 charts today, right?
Yeah.
And I thought I had a new appreciation for why these guys would be surly. And they just explained to me there was one simple trick they would look for in their charts. And I realized that's it. That's all you have to do with a chart to read. Well, the proof was in the pudding. They kept track of their recommendations, and they beat the market by 30 basis points. Now, that might not seem like much, but you gotta understand that's 30 basis points per month. So 1/3 of 1% per month by picking a whole bunch of S&P 500 stocks and saying, here, this is the portfolio we think looks best right now. And month after month after month, they would outperform the S&P market, the S&P benchmark, just by looking at their charts. And I realized that doesn't sound like much of an edge, but that's at the end of the year, it's about a 4 or 5% improvement over and above just the S&P 500. You could literally listen to these guys and say, I'm going to do SPY, hold it all year with half my money, and I'm going to do whatever they say and change it every, once a month based on their list. Yeah. And I would come out with the S&P plus an additional 4 and 5%. And then I realized, gosh, these guys don't play the game this way. But if I did that with options, or if I did that with leverage, in Forex, think how much better I could do. And so in teaching students this method, this banking on randomness method, that's what I found, is that people can for themselves see how they could expect to be earning 20 or 30 or 40% a year just at the end of their first year, and then to improve into their second year somewhere in the area of 60 to 100%. And that's, regular stuff. It's not easy. Not everybody can do it. But if you, the hardest part is just being regular, just following the rules. Most people just simply don't want to follow the rules. They just get excited. This is the trade. Throw on a whole bunch, no risk management. And that's learning the benefit of not doing that all by itself. That alone can change you from unprofitable to profitable trader. Learning a few other techniques like the ones I've refined over 20 years in banking on randomness can supercharge it well beyond that.
Look, what I'm about to say, Gordon, will offend a lot of people, and it's not meant to. It's just a fact, right? We have, and after I did banking on randomness with you, which I called in our staff meeting the most impactful trading education I'd ever done. I thought the first morning of banking on randomness, it just sums it all up. And so we set up a robot, and you know about this robot. It trades a random product in a random direction with a 25-point stop loss and a 25-point target. And for the last 5 months, it's at break even, which means it's outperforming 96% of those Taiwanese traders who are spending their entire day, doing this stuff. And it's also outperforming 90% of retail traders who are trying to learn technical stuff and misusing it and not controlling their risk and not doing the simple things and this is the great part I love about this stuff, Gordon, is that I remember sitting in Singapore with Julian and we're having a beer at the Boomerang and having a chat, and the trading team was sort of sitting just away from us while we had a chat. You could see them looking over, and I remember thinking, they think we're talking about amazingly complicated and difficult stuff, and yet we were talking about the most simple stuff in the back of and the base of trading stuff, like making sure we had some big picture stuff right. And this is what experience teaches you. All the little fruit of the day stuff is rubbish. Get the basics right. Understand there is some randomness to it, and you're a chance, right?
Yeah. We find all we need to do is get a 3 to 5% edge. If you win 50-50 on a 1-for-1 setup, you only need to win 53% to have a stunning difference occur in your account. If you win 5%, you're going to go bragging to your friends about how good of a trader you are, and you will be justified in doing so.
And the difference between the guys in the first year and the guys in the second year is that the guys in the first year are taking, let's say, just a random number, let's say they're taking 10 really poor trades a month, that they know are really poor, but they're bored, or they just lost, or they just won, or they just something, so they're just pushing the button. And they know the trade's no good, but they, you know, and they're giving all this money to the market. And then they've got to be good enough traders to get back to break even. They work the whole month to get back to break even. Next month, they just go take another pile of poor trades. This is the learning experience, right? You learn to stop doing that stuff, right?
Yeah.
Look, I want to let people know how they can get a bit more coverage from you regularly. And 8:30 on Monday nights, we've had the trading show. Buy which stock to buy now, and we're gonna broaden that out, right? We're gonna go with charting for profits right now, and we're gonna add forex, crypto. We're gonna make this more of a whole market show where you're still gonna, as I understand it, coming from Ron Gordon, you're still gonna give them a stock to trade on Monday morning, but we're gonna get into some forex charts and some crypto charts. 8:30 Monday. That's free on YouTube. They can join our Zoom session. We'll put the link in the box now for those that want to watch that in the room with you, so they can ask you questions. It's on YouTube. It's on Facebook. What else?
I'll be
what's going to happen in that show?
I'll specifically be giving one stock to trade, one forex to trade, and one cryptocurrency setup to trade every day. And these aren't, this is the golden egg trade. It's a surefire. I'm going to tell you precisely what the probability for each of these is and what you do with that probability information. So if I say this one has a 70% chance of being right, okay, here's how you structure your risk to make sure that you can handle that. In the trading classes that we're signed up to do, the banking on randomness and several of the others that we have in November, I actually talk about how you can use an expected probability, 30%, 50%, or 70%, or 90 or 10, whatever you choose, to your best advantage in a sort of systematic way. And most people have never heard this before, and it is extremely powerful. It's the ability to know when to scale up. See, I work with some of the guys who I've placed, and I also have interactions with guys that are in proprietary trading firms. And what I learned from them is that they have a specific moment where they recognize, okay, now I've got to step up the risk. Now I got to go bigger on the trade. Well, if you're just doing that because of gut feel, or because you really like the headline you just heard, or because your brother-in-law said it and he is really sure, whatever the reason is, if you're doing that on a trade-by-trade basis, you are blowing away all of your risk management strategy. If instead you're looking at, here's the last 10 trades I made, here's the performance, here's what I have earned in the way of being able to increase my risk. If I haven't earned anything, I do not have the privilege to increase my risk. But assuming I have earned a little privilege, where am I going to put it? Well, that's what this methodologies are all about. How do I start slowly, incrementally, or maybe all at once on one particular trade? And when is the right time to go big? I remember I had a trading colleague who was, his goal was to make $100,000 a year trading. And he was 6 months into the year and he'd only made about $20,000. And in one weekend, he made $40,000 overnight in a trade, and put him right on track for his goal. Yep. And I quizzed him about that. It's like, well, what kind of trade did you make? How did you know? And he went through and described everything. But the big thing was, had he been wrong, he would have cut into his profits for the year, but he wouldn't have eliminated his profits for the year. Whereas if he was right, which he turned out to be, he was going to make this windfall trade. And so it started, he had this fun story of like, yeah, well, I saw Goldman Sachs was going to do this and blah, blah, blah. And he had all these fun little details about it. But the bottom line was, it started with the fact that he had earned the right to go big. And then the opportunity came along. So that whole saying, luck is when preparedness meets opportunity. I've never found a venue where that is more true than trading. You are actually managing luck, so to speak. Certainly managing your preparedness and opportunity.
We shouldn't confuse randomness with luck. Randomness just says there's a level of unpredictability about it, but we still need to be prepared and have a plan and find our edge. And look, it's one of the things I tell people all the time that trading's nothing like on TV. Trading's about finding an edge. and repeatedly and consistently smashing that edge non-stop. And
Yes.
when you find an edge, you need to make every damn cent you can out of it, because there'll be another day where the market conditions won't suit you. I used to work on the trading floor in London, and guys would tell me, look, my target for the month is 5%. So if I'm 5% up, I finish for the month. And I'm like, buddy, if I'm 5% up, I'm going to smash that month. You know, it's going my way.
Right.
I'm in sync. It's working. I'm not going to say, look, I've just had the best 10 days I've had in ages. I'm going to stop now. I'm going to go, actually, right. I'm in sync. Let's make some money right now. And when the market's not nice, I'll just control my risk and be patient, you know?
Yeah. See, and you do that, and you're setting up your risk reward, really, to begin with. And so you have earned the right to consider where an opportunity might come along.
Yeah, I like it, Gordon. Look, just having a look to make sure I haven't missed anything I really wanted to speak about. What I might get you to do, if you don't mind, is I'm going to take this recording. We're going to play it in Meet Your Trading Experts in about, it's Wednesday morning, Thursday night. Would you mind at some stage sending me through the names of the books and the authors, so I can put them in the chat that you talked about, so that we can have, if anyone wants to have a read of those books and reference them, they can. We're going to talk a little bit more. I really appreciate your insight into the CMT. I think there's a couple of different qualifications. You're a CMT, I think. Is Angie a CTA? Angie's you're a CMT. She's a certified financial technician. CFT, is she? That's fine.
CFTC. I think a CFTC is the IFTA's designation.
Yeah. So we'll talk a little bit about those qualifications in coming shows. Look, Matt, I really want to thank you for your time today. People, if you want some more, Monday nights with Gordon at 8:30 Sing. Now, US daylight savings will come in and move that around a little bit, I imagine. Gordon, that's still a few weeks away, isn't it, for US? And then we've got this Sunday for Banking on Randomness. To the Action Wealth trading team, I called it the most impactful education I've ever done. I thought the morning in particular, that was amazing. I really recommend you do it. Look, you know, if you can't find $150 to do a trading course, I've got to wonder where you've got the resources to really succeed at this. It's a bloody good investment. Make the investment. Join Gordon on Sunday and have a great day from it. To you, my friend, thank you very much for your time. I really appreciate it. We'll be back in touch soon. In the meantime, must be getting late over there. Enjoy your evening.
Thank you very much.
Cheers, Gordon. Thank you. See ya. There we are, guys. My recorded interview with Double Paul. Yes, Crystal, there's two of me. I mean, one of me is big enough. Two of me is a bit much, really. Look, so there's my interview with Gordon Scott, CMT. I thought there was some really fascinating stuff in there. I do encourage you guys to have a little play back of that at some stage and see if you can put out some of the really great trading information in there. There's some great stories, but some great trading stuff as well. And look, I'm not kidding. I told my trading team that I thought that the morning of Banking on Randomness was the most impactful trading education I'd ever done. And I've done a little bit along the years to get to here, guys. And the links are in there. I might have put them back in again into the chat, but Banking on Randomness and Supercharging Your Trading Income or Trading Profits are very similar. Those two courses are very similar. We're basically going to rebrand Banking on Randomness and make it more, which is a bit stocky. We're going to make it more forexy. So those two are similar, but you can do one of those for 147, all of those for 347. And honestly, you get Gordon Scott. If you do that, you get Gordon Scott for 4 days. And you know, I'd have to imagine for most people, $300 is, you know, less than 10% of their trading account. And, you know, I would suggest you're going to make that, in my opinion, you're going to make that back. So I do encourage you guys that haven't done it. We've been pushing the Master Trader thing with Gordon in there for a little while now. And now we are very keen to get as many people through this as we possibly can. Yeah, Stuart, you can buy the other courses for $147 each. So if you've done Banking on Randomness, I'm quite happy to give you a Supercharger trading income. If you pay $147 each, look, it's $300. You get the other two, the options and the, God, I can't remember what they're called. And look, one of the things with this, leveraging your edge and low cost, leveraging your edge, which is options, and low cost growth stocks, which is really his bread and butter. That's what Investopedia held him for years to do, was to talk about low cost growth stocks. Again, if you need to talk to the team, look, Banking on Randomness is Sunday. The rest of them, from memory, 6/13. For some reason, I think it's 6/13/28 of November. So the other three are in November. And we haven't done them yet, so it'll be the first time we run them out, and I would encourage you guys to jump into those if you can. Look, before you do, I'm going to give away a banking your randomness with mine. Mike, can we give away a banking on randomness, please? Congratulations, Janet. Looking nice to see you in the attendees today. We've got others on Facebook and others on YouTube and others on Twitter, everyone out there. But Janet, can you let us know that you're in the room still? And if you are, we will organise for Mike to get those details. Crystal wins. Crystal the Chandelier. How did you become the Chandelier this week, Crystal? Gosh, there's some jokes that go on between you guys in the background. I'm in. There we go, Janet. Janet is our winner. Will pass your details on to James. He'll be in touch, and you're welcome to join Gordon on Sunday for Banking on Randomness. Look, I'm yet to confirm, but I have a busy few weeks lined up. I think that next Thursday it'll probably be Shukri, and we'll be talking about his wallet class on a Sunday, plus the staking course, plus Crypto Moon 3, which is closing soon, which includes NFTs. NFTs are that big thing going on in the crypto world. I think I'll have Ainsley in the week after that to talk about her qualification, which is the CFT, and a little bit about what's entailed in that. I want to sort of see if I can bring you guys some information around these guys that have done these professional courses on top of our courses, and the content of that kind of stuff and the difference it makes for them as traders and educators. And then we'll have Simon, and not the Simon you guys are thinking of, not Crypto Simon, Forex Simon. Forex Simon's going to come and tell you guys a little bit about a strategy that he's going to be teaching in October. Some sensational results. We released it for the first time into the new IFP guys on Tuesday. If you missed that, you really did miss out. Going to be a busy few weeks. Then we'll have a couple of weeks off on the IFP again. We've got another one of those. We're going to do a couple back-to-back for a change. Look, I just want to finish on this. The one thing that experience teaches you is calmness. When you listen to Gordon speak, his calmness just comes through for mine, and that's what experience teaches, and that's what you're learning over a long period of time of trading, how to stay calm and make good decisions. And if you do that, everything does work out. So my last comment always for you guys is to remember, stay calm and make good decisions, and it all will work out. Thanks for joining me. I'll be back next Thursday. Same time, we'll confirm in the promo stuff on the way in, but I expect we'll probably have Shukri Harman here talking crypto. Always a good time. Always some amazing insights. That man is a genius. Cheers, everybody. See you later. Have a good night.